Hi everyone, I'm Teng Chong from the iFAST Fixed Income team, and on this video, I will help you better understand perpetual bonds, where I will touch on bank capital instruments, specifically Additional Tier 1 bonds. Additional Tier 1 bonds, or AT1s in short, are a type of perpetual notes issued by banks to contribute to their core equity base and meet the level of capital requirements set by regulators. Following the collapse of several well-known banks during the global financial crisis, banking regulators have imposed higher capital adequacy norms that financial institutions have to adhere to. Over the years, AT1 bonds have become mainstream among retail and institutional investors as they offer higher yields compared to senior bonds of the same issuer. However, with higher yields, AT1s also bring about greater risks, and we will go through some of the key features of these perpetual bonds to highlight the risks that are embedded in them. Firstly, in terms of seniority, AT1 bonds are junior subordinated in nature, which means that they are ranked lower as compared to senior and subordinated bonds issued by the same bank. As such, the issue ratings of AT1 bonds are usually lower as compared to the credit ratings of the issuer. Secondly, AT1 bonds are callable and resettable. They do not carry a maturity date, and the first call date usually falls between 5 to 10 years from its issue date. Following a non-call event, the coupon of the AT1 bond will be reset based on the reference benchmark rate plus a credit spread, and subsequent call dates may vary depending on the bond and the issuer. One risk is that there is no guarantee of redemption on the first call date. For example, during the pandemic, several well-known banks such as Deutsche Bank and Lloyds Bank decided not to redeem their AT1 perpetual bonds due to economic reasons, as it was more expensive to refinance their perpetual notes during the pandemic as a result of credit spreads widening. Another feature of AT1 bonds is distribution deferral. Often, distributions of AT1 bonds are non-cumulative in nature. As such, the issuer can choose not to pay any distributions to perpetual bond holders, and such unpaid distributions will not accumulate and accrue interest. This is in contrast with senior bonds where the issuer is obliged to make regular interest payments to investors, and skipping payments may be construed as a credit default event. However, to incentivize the issuer to not skip distribution payments to perpetual bond holders, AT1s may also contain distribution pusher and stopper clauses. Distribution pusher means that if the issuer has already paid dividends to holders of securities that are ranked equal or junior to the AT1 bonds, such as common equity within the past 6 to 12 months, then the issuer must pay distributions to perpetual bond holders. Meanwhile, the distribution stopper means that in the event if the issuer decides not to pay distributions to perpetual bond holders, the company shall not pay dividends in respect of its junior securities or other securities that are ranked equal to the AT1 notes. The final and most important characteristic of AT1 bonds is their loss absorption feature. AT1 bond investors should be mindful of this clause, as they could potentially lose most, if not all, of their capital in the event of if the loss absorption clause is triggered. Typically, there are two types of loss absorption options. The first option is write-off, where the issuer shall reduce the principal amount and cancel any unpaid distributions of the perpetual bond. A write-off can be partial or in full upon the occurrence of the trigger event. The second option is conversion, where the perpetual bond will be converted into the underlying shares of the issuer based on a multitude of factors such as conversion ratio, purchase price, and nominal value of the shares. Investors should also note that the converted ordinary shares may be worth significantly less than the AT1 notes. The trigger event that will activate the loss absorption feature usually happens when the bank's capital adequacy ratio falls below a certain threshold, or if regulatory authorities deem that it is necessary for the bank to write off or convert its AT1 notes to prevent it from becoming insolvent. The minimum capital adequacy requirement varies across different bank capital instruments. For example, the minimum Common Equity Tier 1 or CET1 threshold for the Commerzbank 7% perps is 5.125%, while the minimum CET1 threshold for the UBS 7% perps is 7%. So, are AT1 bonds suitable for investors? Despite having a loss absorption feature, most banks and financial institutions have started building up their conservation and countercyclical buffers on top of their minimum capital adequacy requirements following the global financial crisis. Besides that, the Basel Committee has also identified major financial institutions as globally systematically important banks, which is defined as banks that are too big to fail. These banks are usually required to hold additional capital and are often stress tested by their respective national banking authorities. Looking at the latest CET1 ratio of major banks, it is unlikely for them to trigger the loss absorption event in the near future. Furthermore, during an economic downturn, many banks have opted to cut their dividend payments to common equity holders to preserve capital, even though they have met the minimum requirements to pay out dividends. As such, we think that the conservative nature of most financial institutions and strong build-up in capital have well insulated themselves from an economic crisis and write-down of AT1s. Nonetheless, investors should be mindful of the potential write-off or conversion risks despite the well-capitalized nature of banks. These AT1 bonds act as buffers in times of stress, and the recent example of Yes Bank, one of India's largest private banks, writing down its AT1 bonds before its common equity demonstrates that perpetual bondholders could be at risk of losing their capital before shareholders despite AT1's ranking superior to common equity. Besides the risks mentioned so far, the general risks of perpetual bonds covered in the previous video, such as interest rate risks and subordination risks, also apply to AT1s. Therefore, investors should acknowledge the additional risks in return for the yield pickup that AT1's bonds offer. Even though banks have a good track record of redeeming their AT1 bonds on their first call dates, investors should still price in a potential non-call risk, as the cost of refinancing will play an increasingly important role on top of capital preservation, particularly during an economic downturn. We have come to the end of today's episode, and I hope you now better understand AT1s. Thank you and see you in the next video.